Hello everyone. Welcome to the weekly current affairs focus for the Indian economy. In this particular session, I shall be covering the important economy related articles from various sources such as The Hindu, Indian Express, Business Line, Business Standard and so on. For this particular week, as you can see, I have picked up 5 topics, two important economic terms in news as well as two schemes in news. The first article shall be about the exchange traded funds, wherein we shall be discussing what do you mean by exchange traded funds, types of exchange traded funds, as well as different financial instruments in terms of gold. The second article is about the startups. On Jan 15, we have recently celebrated the National Startup Day. In this particular regard, we will understand the definition of startup, the government initiatives for startups, as well as the important concept of flipping and reverse flipping of startups. The next article is related to the stress in the microfinance sector as highlighted by the RBI's financial stability report. The next article is about the data embassies, wherein recently it has been highlighted that UAE could become the first country to set up data embassy in India. The next article is about what steps should the government take to control the volatility in agricultural commodities, which becomes important in the context of the recent farmers' protest. The next article is about the important economic terms in news, that is interest coverage ratio as well as debt coverage ratio. So let us start with our discussion, wherein the first article which I shall be taking up is about the gold exchange traded funds. Recently, it was reported in the media that the amount of inflows into gold exchange traded funds has reached its all-time highest in the last 6 years. Now, why is this topic important? Reason number one, as you can see in prelims 2024, there was a question wherein you were required to identify as to which of the instruments are financial instruments. And one of the option, as you can see, was exchange traded funds. Reason number two, as you can see, in prelims 2016, a question has been asked with respect to financial instrument in gold, that is sovereign gold bond. So keeping in mind the requirement of UPSC prelims examination, we shall be discussing the meaning and types of exchange traded funds as well as different financial investments in gold, that is sovereign gold bond, gold exchange traded funds, as well as electronic gold receipts. After discussing these concepts, I shall be taking up these 3 practice questions at the end of our discussion. So let's start with the understanding of what do you mean by exchange traded fund. For that, let me just give you a simple example. Let's say Government of India wants to undertake disinvestment of PSUs. Let's say the government wants to sell the shares of 4 PSUs, that is SBI, ONGC, NTPC and Coal India. The total number of shares which the government wants to sell is 25 plus 20, that is 45, 45 plus 25, 70, 70 plus 30, that is 100. Totally, the government wants to sell 100 shares of 4 PSUs. And by selling of these shares, government wants to mobilize totally rupees 1000. Now to undertake disinvestment of these 4 PSUs, there is one option. In option 1, the government can individually, one by one, sell the shares of these PSUs. For example, government can initially sell 25 shares of SBI, followed by 20 shares of ONGC, followed by 25 shares of NTPC, and so on. So in option 1, individually, one by one, the government can sell up the shares in the PSUs. But there's a problem in option 1. The problem here is that it would be very time consuming as well as cumbersome to individually sell the shares of the PSUs. That is where option 2 of exchange traded funds come into being. So what happens in exchange traded funds? See, in case of exchange traded fund, instead of individually selling the shares of PSUs one by one, the government together sells the shares of all of these PSUs through exchange traded fund. How does this work? Now, the government totally wants to sell 100 shares of 4 different PSUs and get totally 1000 rupees, right? So what will the government do is government will transfer all of these shares to a fund manager. The fund manager could be a private sector entity. Take for example Nippon India or ICICI Prudential. To that particular fund manager, the government will sell off its shares or transfer its shares. And the fund manager, what will it do is it will convert the government shares in PSUs into exchange traded funds. For example, think how much money the government wants to get through the shares of PSUs. Totally 1000. So the fund manager, what it will do is it will convert these shares into ETF. Let's say it convert these shares into 100 ETF, and value of one ETF would be equal to rupees 10. So totally it will sell 100 ETF units. Value of one unit is rupees 10. So 100 ETF units into 10, that is rupees 1000. So fund manager will sell 100 UTF units at rupees 10, get 1000 rupees and gives that 1000 rupees to the government. So when the fund manager sells the ETF to the investors, now imagine that if I am one of the investor who buys these ETF units. So let's say I, as an investor, I purchase 50 ETF units. One ETF unit is worth how much? Rupees 10. So if I purchase 50 ETF units, which means how much money would I have invested in the ETFs? Totally, I would have invested 100 rupees. Sorry, 500 rupees. Now, where is this 500 rupee actually invested? This 500 rupee is not invested in share of a single PSU. This 500 rupee is invested in shares of 4 different PSUs. That is SBI, ONGC, NTPC and Coal India. And what you must understand is ETF unit will always track the price of the underlying asset. What is the underlying asset here? The underlying asset is share. So value of ETF unit will be in turn based upon share prices of these 4 PSUs. So if the share price of these 4 PSUs increase, value of ETF would also increase. For example, if I have initially purchased ETF unit at rupees 10, later the share price of all of these 4 PSUs increase. So the initial value of ETF could increase from rupees 10 to rupees 15. Same logic, if the share prices of these 4 PSUs reduce, the value of ETF would also reduce. Let's say it might reduce from rupees 10 to rupees 8. So ETF will always track the value of the underlying asset, which in this case happens to be the share. So these ETF units we can very well trade on the stock exchanges like BSE, NSE, and so on. So just like the way you would trade shares, bonds, etc., you can also trade the ETF units. Now, what are the benefits of exchange traded fund for the government and for the investor? See, from the perspective of government, the amount of time which is needed for undertaking disinvestment through exchange traded funds is considerably less. So government gets benefited because the disinvestment process gets fast tracked. As far as investor is concerned, in the financial market, there's a golden rule which says never put all your eggs in one basket, which generally means always diversify your risk. So let's say there is one particular investor. This investor has purchased the shares of only State Bank of India. If the value of the share of SBI reduces by 10%, this particular investor who has invested only in the shares of SBI would incur a loss of 10%, right? On the other hand, imagine a smart investor who has invested in exchange traded fund. It might so happen that the share price of SBI could reduce by 10%, whereas the share price of Coal India could increase by 20%. Share price of SBI reduced by 10%, Coal India increased by 20%, which means whatever loss this investor is incurring in the SBI share, that loss is not only compensated by increase in the share price of Coal India, but the shareholder or the investor earns a net profit of 10%. So that way, exchange traded fund is a win-win situation. The government gets benefited as well as the investor would also get benefited. So if you look at the definition of exchange traded fund, it is a fund which invests in assets like shares, bonds, or commodities such as gold. Once it makes investment in these assets, the value of ETF will closely track the prices of these assets, that is shares, bonds, as well as commodity, that is gold. So based upon in which particular asset the fund is investing money, exchange traded funds can be broadly categorized into three types. If the exchange traded fund is investing in shares, the example that we have seen, then we will call it as equity based ETF. The fund can invest in bonds issued by different companies. In that case, we would call it as debt based ETF. The fund could invest in physical gold. If it invests in physical gold, then it will be considered as gold based ETF. To give you more clarity with respect to share based and debt based ETF, let's take an example here. See, for undertaking disinvestment of PSUs, the government is using the option of ETF, wherein the government of India has come up with two exchange traded fund, share based exchange traded fund, which is CPSE ETF and Bharat 22 ETF. Both are share based ETF. So it is like saying, if you as an investor, if you purchase CPSE ETF or Bharat 22 ETF, rather than buying one single share of PSU, you are actually purchasing multiple shares of PSUs. So that way you are diversifying your risk. Similarly, in order to borrow money, the government of India has come up with Bharat Bond ETF. So if you as an investor, if you purchase Bharat Bond ETF, It is like saying, instead of purchasing one single bond of a PSU, you are purchasing multiple bonds of PSUs. So you are lending your money to multiple PSUs. So as the bond prices increase or decrease in the secondary market, the value of your bond, Bharat bond ETF, would also change accordingly. So having understood this concept, let's get into the working mechanism of gold exchange traded fund. So here, let's say there is a particular fund manager. The fund manager will initially buy and store physical gold. Let's say the fund manager purchases 100 gram of physical gold. This particular gold is kept in the safety vault. Against this physical gold, the fund manager will issue exchange traded fund. Generally, one ETF is equal to 1 gram of gold, which means against 100 gram of physical gold, the fund manager can issue 100 gold ETF. Initially, when this ETF is issued by the fund manager, the value of 1 gram gold could be rupees 3000. So if you buy one gold ETF, you would probably invest up to rupees 3000. So like I said, exchange traded fund will closely track the value of the underlying commodity. And what is the underlying commodity here? Gold. So as a gold price increase or decrease, the value of the gold ETF would also increase or decrease. For example, in the market, if the value of physical gold increases to rupees 4500, the value of your gold ETF, which was initially 3000 rupees, its value would increase to 4500. The value of physical gold reduces to rupees 2000. The value of your gold ETF, which was initially 3000, its value will get reduced to rupees 2000. Right? Similar to shares, the gold ETFs are traded on stock exchanges like BSE, NSE, and so on. Nextly, see, if I have purchased a gold ETF, I can very well sell the gold ETF to another investor. When I sell the gold ETF to another investor, I will be paid in terms of cash. I will not get the gold. So please understand, if I sell the ETF in the secondary market to some other investor, that investor will not give me gold. That investor will pay me a cash, right? Whatever is the value of ETF, that much cash he will pay to me. So generally, ETFs are generally not convertible into physical gold. But at the same time, let me tell you, there are some fund managers which have a provision of converting the ETFs into physical gold. But to do so, you should be a large investor. How large investor? As you can see, if you're a large investor who has purchased 1000 units or more, one ETF unit is 1 gram. 1000 ETF units means 1000 gram, which is like 1 kg. So if you have purchased 1000 units of ETF, it generally means that you are a large investor. And if you're a large investor, you can redeem the ETF units from the fund manager into physical gold. So you can give your ETF units to the fund manager if you are a large investor. In return, the fund manager will pay you in terms of physical gold instead of cash. But that is a facility provided only by few fund managers. That to be if you're a large investor. Some of you must be thinking, why should I purchase the gold ETF when I can purchase physical gold? Now, what are the advantages of purchasing physical gold? Why do people purchase physical gold? Reason number one, the value of gold might appreciate. Reason number two, you can use that physical gold as a collateral in order to obtain loans. But there are problems with respect to physical gold. Problem is with respect to storage as well as theft, right? Plus, if you are buying a gold jewelry, you are required to pay certain percentage in terms of making charges, right? So when it comes to gold ETF, it gives the same features of physical gold and negates the disadvantages of physical gold. Think of it. Just like physical gold value increases or decreases, your value of gold ETF will also increase or decrease. You can use your physical gold as a collateral to obtain loans. You can also use your ETF as a collateral to obtain loans. Apart from that, if you have a gold ETF, you do not have a problem of storage because the gold ETF is actually kept in your demat account, right? Apart from that, there is no concept of making charges because you're not buying a gold jewelry. Rather, you are buying a financial instrument. So these are the benefits of gold ETF. As far as taxation is concerned, you are required to pay capital gains tax if you make profits on selling your ETF units. I purchase ETF unit at rupees 3000, sell the ETF at rupees 4000. I made a profit of rupees 1000. On that profit, I will be required to pay capital gains tax. But STT, Securities Transaction Tax, which is the tax which is paid on buying and selling of various financial instrument, this STT is not applicable on the exchange traded funds. And like I said, the amount of inflows into gold exchange traded funds has increased to its highest level in the last 6 years. So what are the reasons for the increased demand for gold exchange traded funds? Reason number one. So you must understand, whenever there is inflation, inflation means two things. On one hand, prices of goods and services, including gold, is increasing. Second is the purchasing power of currency reduces. So think of it, during inflation, if I keep cash with me, the value of that cash is going to reduce. And what is happening to value of the gold? The value of the gold is increasing. So don't you think it is better that during inflation, instead of holding cash with me, I should buy gold because I can get benefited due to appreciation in the value of gold. So in the last few months, as you know, the rate of inflation in India is higher. So because of higher inflation, the demand for gold ETFs has also increased. Secondly, you must be knowing that there has been large scale outflow of FPI from the Indian share market. So there is large scale volatility in the share prices. So people are expecting that if they invest in shares right now, the share prices might reduce. So as compared to shares, gold ETFs have become more attractive now. Third reason is, generally, if you want to invest in financial instruments in gold, one of the best option in India is sovereign gold bond. But recently, in December 2024, there was a report in the media that the cost of issuing sovereign gold bond has been increasing for the government, particularly in terms of interest payments. So government has decided to put on hold the issue of sovereign gold bonds. So think of an investor. I can invest in sovereign gold bond or I can invest in gold ETF. now the issue of sovereign gold bond is put on hold. For me, the only option is to invest in gold ETFs. So these are some of the reasons why there has been increased demand for gold ETFs. Now coming to the concept of sovereign gold bond. I hope all of you know about the government securities. Government of India issues government securities in order to borrow money from the market. These are generally called as dated bonds. Dated bonds will have three features. Face value, which denotes how much money the government is borrowing. Coupon rate denotes how much interest the government is going to pay. Maturity denotes for how long is the government borrowing money. Soaring gold bonds are similar to dated bonds, except the fact that the face value of soaring gold bond is not in terms of rupees, rather the face value is in terms of gold. So you know that the government securities are issued by RBI on behalf of the government, right? Same way, sovereign gold bonds are issued by the RBI on behalf of the government. These sovereign gold bonds, they are denominated in gold. For example, for normal dated bond, the face value will be in terms of rupees, like rupees 100, right? But in case of sovereign gold bond, the face value is denominated in terms of gold. For example, minimum is 1 gram. So let's say when RBI is issuing sovereign gold bond, the value of 1 gram gold in the market is equal to rupees 3000. So if I am purchasing this sovereign gold bond from the RBI, how much money should I give to RBI? Rupees 3000, which is value of 1 gram of gold. When I lend money to the government, in this particular case, I will get a interest of 2.5% every year. Understand this interest of 2.5%, it is paid on the face value when it was initially issued. So in this case, what is the face value when it was initially issued? Rupees 3000. So 2.5% of rupees 3000, that is rupees 75, is what I will get as a interest every year. For how many years? The maturity is 8 years. I'll continue to get interest for 8 years. Plus, there is a lock-in period of 5 years. So what is this lock-in period of 5 years? Lock-in period of 5 years means once I purchase a sovereign gold bond, I cannot go to RBI and ask RBI to give back the money, or I cannot ask RBI to redeem the bond for at least 5 years. After 5 years, anytime between 5 to 8 years, I can go to the RBI and I can ask the RBI to redeem the bond. But also understand that what if I'm in immediate need of money? I've invested in sovereign gold bond, I'm in immediate need of money. In that particular case, I need not wait for 5 years. I can sell this sovereign gold bond to a investor, another investor in the secondary market, and whatever is the market value of the 1 gram of gold, that much price I will get back from the another investor. So lock-in period is with respect to redemption of sovereign gold bond from the RBI. Lock-in period is not with respect to sale of sovereign gold bond in the secondary market. Please understand the difference in this particular case. So investors will earn interest on sovereign gold bond until 8 years, and upon the maturity, that is after 8 years, or after the lock-in period ends. What is the lock-in period? 5 years. After the lock-in period ends, after 5 years or upon the maturity of 8 years, investors can redeem the bond in cash. Please understand, upon the maturity, you don't get gold, you get cash. How much cash will you get? It will depend upon the prevailing price of the gold during redemption. For example, let's say this particular bond was issued in the year 2020, where 1 gram gold value was equal to rupees 3000. It might so happen that after 8 years, that is in 2028, the gold price appreciates to rupees 4000. I will not get back 1 gram gold. Rather, I will get back the prevailing price of the gold after 8 years, which is rupees 4000. But at the same time, what you must understand here is there's no hard and fast rule that the investor would always get benefited. It might so happen that after 8 years in 2028, the value of this 1 gram gold could reduce to rupees 2000. In that case, investor would not get rupees 3000, rather investor would get only rupees 2000, and hence investors could incur a particular loss. What are the benefits of sovereign gold bonds? Sovereign gold bond would track the prices of gold, the physical gold, just like ETF. There's reduced risk of storage and you can use it as a collateral. And plus, one benefit which sovereign gold bond gives as compared to ETF is that on sovereign gold bond, you'll earn an interest of 2.5%. What about taxation? Now, this is little difficult. Let me explain this. With respect to taxation, let's say you redeem the bond from the RBI. And when you redeem the bond from the RBI, after the lock-in period of 5 years or upon the maturity of 8 years. If you redeem the bond from the RBI and upon redemption, if you make profit, that is when you redeem the bond from the RBI. In that particular case, you are not required to pay capital gains tax even if you make profits, provided you have done the redemption from the Reserve Bank of India. On the other hand, if you sell the bond in the secondary market, and when you sell the bond in secondary market, on that if you make profits, you're not redeeming it from RBI, you are selling it in secondary market, and on that you are earning profit. In that case, you will be required to pay capital gains tax on the profits. So that is one important concept that you should know. So as you can see, you are required to pay capital gains tax on selling sovereign gold bonds before maturity in the secondary market. However, you are not required to pay capital gains tax if sovereign gold bond is redeemed from the RBI either upon the maturity or after the lock-in period. How is it different from gold ETF? Gold ETF is always backed by physical gold. So when a fund manager issues gold ETF, against that gold ETF, the fund manager would have physical gold, right? But when the RBI issues sovereign gold bond, against this sovereign gold bond, there's no backing of physical gold. That is one important difference. The second difference, as I discussed earlier, on gold ETF, you'll not be getting any interest, but on sovereign gold bond, you will be getting the interest. These are the two important differences. Now coming to electronic gold receipts. So what are these electronic gold receipts? Now let's say there is a large importer. This large importer imports gold from outside India. After importing gold, this importer will store the gold in the vaults recognized by SEBI. So let's say this importer imports 100-gram gold, and this 100-gram gold is deposited in SEBI recognized vault. Now what will the vault do? Vault will convert this physical gold into electronic gold receipts. And this electronic gold receipts is issued into the demat account of gold depositor. So the gold depositor will now have 100-gram worth electronic gold receipt. it's like a receipt acknowledging the fact that the person who has this electronic gold receipt has physical gold in the safety vault recognized by SEBI. The value of this electronic gold receipt tracks the value of physical gold, just like your ETF. Electronic gold receipts are traded on the stock exchanges, and the buyer of electronic gold receipts can convert electronic gold receipts into physical gold from the vault. For example, let's say you have a person A and this is person B. Person A has 1 gram electronic gold receipt worth rupees 3000. He will sell it to B and B will pay him rupees 3000. So he can sell it to the B in this particular case, and B can in turn convert this EGR from the vault. So using that receipt, he can take out physical gold worth 1 gram. Apart from that, you need to know about the taxation on electronic gold receipts. How is the taxation working here? Let me explain this. Now, for example, there is person A. This person A buys electronic gold receipt at rupees 3000, and then he sells electronic gold receipt at rupees 4000 to another person B. Can you see? A is purchasing it at 3000, selling it at 4000, which means A is making a profit of how much? 1000 rupees. Because he is making profit on sale of electronic gold receipts, A will have to pay capital gains tax. See here, B has purchased electronic gold receipt at rupees 4000. It might so happen that after a year, the value of EGR might increase to rupees 5000. B might not sell this particular electronic gold receipt to another investor. B can go to the vault. To the vault, the B can give this electronic gold receipt and get the physical gold worth, let's say, 1 gram. Think of it. Can I say even B has actually made profit? Because when he bought electronic gold receipt, value of 1 gram gold was equal to rupees 4000. He's converting this EGR into physical gold. And when he's converting this into physical gold, the value of 1 gram gold is equal to rupees 5000. Here also is making profit, right? But in the budget of 2023, government has declared that if you convert your EGR into physical gold from the vault, and upon that conversion, if you make profit, in that case, you are not required to pay capital gains tax. So can you see, in this particular situation, A pays capital gains tax because he's selling the electronic gold receipts, and on that sale he's making profit. B does not pay capital gains tax because he is not selling the electronic gold receipts, rather he is converting electronic gold receipts into physical gold. So that is important aspects related to taxation. And how is electronic gold receipt different from sovereign gold bond? As you can see, sovereign gold bond, they are interest bearing, whereas electronic gold receipts, they are non-interest bearing, similar to your exchange traded funds. Sovereign gold bonds cannot be converted into gold, whereas electronic gold receipts can be converted into gold. So that way, the electronic gold receipts, you can consider them similar to this ETFs owned by large investors, because even they can convert ETFs into physical gold. Sovereign gold bond have a maturity of 8 years, but the electronic gold receipts do not have any particular maturity. So these are some of the details that you should know with respect to different financial instruments in gold. I hope you have understood this concept. Let's take up the practice questions now. So if you see the question asked in prelims 2024, which of the following are considered as financial instruments, exchange traded fund and currency swap? Answer is D. If you see the question, practice MCQ number 1, with respect to sovereign gold bonds, consider following statements. The money raised to sovereign gold bond is part of government fiscal deficit. True. It enables the investors to redeem bond in either cash or gold. They can redeem only in terms of cash, not in gold. The coupon payments are linked to market price of the gold. You get a coupon payment of 2.5%. 2.5% of what? 2.5% of the initial face value. You will not get 2.5% of the market value of the gold. Understand that, right? So the statement here is incorrect. The right answer is 1 only. Practice MCQ number 2. Which of the following are benefits of electronic gold receipts in India? The electronic gold receipts would drastically reduce the import of gold. It has nothing to do with import of the gold, right? Because large importers will import gold, store it in the safety vault, and the gold gets converted into electronic gold receipts. Conversion of EGRs into physical gold does not attract capital gains tax. It is correct. Investors do not earn interest on EGR. Right answer is 2 only. Coming to the third practice question, the gold exchange traded funds are generally not convertible into physical gold. Generally, in most of the cases, you cannot convert your gold ETFs into physical gold. You can do so only if you're a large investor, right? So the first statement is correct. The gold exchange traded funds are not backed by physical gold. They are actually backed by physical gold, right? So the second statement is incorrect. So the right answer is C. Statement 1 is correct, but statement 2 is incorrect. Having understood this particular topic, let's move to the next topic. The next topic is related to startups in India. See, recently on Jan 15, we have celebrated the National Startup Day. It is being said that we have more than 1.5 lakh registered startups with the government. We have more than 110 unicorns, that is startups with a valuation of more than $1 billion. Startups help in wealth creation as pointed out by Economic Survey. Economic Survey highlighted that if there is 10% increase in the startup registration at the district level, the gross district domestic product increases by 1.8%. So startups do play a very important role in ensuring that India meets its target of Viksit Bharat by 2047. In this regard, there are two important news related to startups. One news is about reverse flipping of startups, and the second news is about fund of funds for the startups. So, based upon the requirement of UPSC prelims examination, we'll discuss what is the meaning of startup, what are the initiatives for startups, and the concept of flipping and reverse flipping of Indian startups. Based upon our discussion, we will take up these two practice questions. So let's start with what do you mean by a startup? See, according to the criteria specified by the government, to be eligible to be considered as a startup, a particular company would have to fulfill two criteria simultaneously. Criteria number 1, the company should be less than 10 years old. Criteria number 2 is its annual turnover during those 10 years should be less than rupees 100 crores. Only when these two criteria are simultaneously satisfied, we can call a company as a startup. For example, let's say there is a particular company which is more than 10 years old, but its annual turnover is still below 100 crores. We will not call this as startup because the first criteria is not fulfilled. There could be another company. This company might be less than 10 years old, but its annual turnover has exceeded more than 100 crores. Here, the second criteria is not fulfilled, so we'll not consider that company as a startup. So, to be considered startup, both the criteria should get satisfied. Apart from that, there are some terms related to startups which we generally come across. These terms are unicorn, gazelle, and cheetah. What is a unicorn? Unicorn is a startup whose valuation is more than $1 billion. Gazelle is a startup whose valuation, which is likely to become unicorn in the next 3 years. Cheetah is a startup which is likely to become unicorn in the next 5 years. Apart from these terms, there are some other terms related to startups. For example, you have zebra. Now, zebra startups are those startups which do not give a lot of focus on growth, that is their own growth. Rather, zebra startups give a lot of focus on social and environmental costs. In that particular case, such startups we call them as zebra. Camels. There are some startups which do believe in organic growth. That means they don't believe in fast term growth by having a lot of venture capital. There are some startups which believe in long term organic growth without relying too much on venture capital. Such startups we call them as camels. Third is cockroaches. Cockroaches basically means those startups which are able to thrive in the worst of economic conditions or economic situations. In fact, during economic crisis, most of the startups might fail, but the cockroaches startups might see this as an opportunity and they can grow even much faster. Such startups we call them as cockroaches. For the startups in India, one of the most important initiative of the government is Startup India scheme. As you can see, under the Startup India scheme, there are basically three pillars. Pillar number one, hand holding. Pillar number two, funding. Pillar number three, incubation. As part of hand holding process, basically we are focused on improving the ease of doing business. Ease of doing business means making it easier for the startups to register themselves, making it easier for the startups to follow the government rules and regulations, or making it easier for the startups to close down their business, that is exit. As part of funding, the government is providing them funding, and one of the most important routes through which government is giving funding is through fund of funds, and that is what I will be covering in the next part. Apart from that, government also gives income tax exemption to startups for a period of 3 years. And third is incubation. Incubation means supporting the startups so that they are able to upscale their business and grow faster. So, as part of incubation, we focus on having linkages between industry and academia. We focus on having certain events where we provide the necessary support to the startups. All the details are given here. I hope you should be able to go through this. Now, let's understand what do you mean by fund of funds. But for that, let me first explain to you what is alternate investment fund. All of you know about mutual funds, right? What do mutual funds do? Mutual funds, they mobilize money, capital from different investors. After mobilizing capital from different investors, mutual fund companies will then invest in different financial instruments like shares, bonds, commercial papers, and so on. Similar to mutual funds, you have alternate investment funds. Similar to mutual funds, alternate investment funds mobilize capital from different investors, and the capital so mobilized is in turn invested in different sectors. So you must be thinking, then what's the difference between mutual fund and alternate investment fund? Almost same, but with one major difference. In case of mutual fund, you could make an investment of as low as rupees 500. Some of you must have heard about SIP, right? You can start your SIP with an amount of as low as rupees 500. But when it comes to alternate investment fund, it is not for people like you and me. In case of alternate investment fund, the minimum investment which is needed is 1 crores. So which means alternate investment funds is more suitable for high net worth individuals. I hope you're getting it right. So when you see alternate investment funds, they mobilize money from domestic investors, foreign investors, minimum investment being 1 crore from each of the investor. Alternate investment funds, they are registered as trust or company, and they are regulated by SEBI. Once the money is mobilized, the money is invested in different sectors like infrastructure, real estate, startups, or MSMEs. As per SEBI, there are three categories of alternate investment funds. Category 1 alternate investment funds are those funds which invest in the projects which we consider as socially and economically desirable. And these are generally the projects which are in early stage. For example, all of you must have heard about venture capital fund, right? Which invest in startups. So venture capital fund is actually an alternate investment fund. Similarly, small and medium enterprises fund, which will invest in MSMEs, or infrastructure fund, which will invest in early stage projects. Category 2 alternate investment funds are those funds which invest in meeting operational requirement of existing project. So look at the difference. AIF1 will invest money in early stage projects. AIF2 will invest money in already operating projects. For example, let's say a new road is to be constructed. Because it's an early stage project, AIF1, that is infra fund, would invest in such project. On the other hand, let's say there is a 4-lane national highway. This 4-lane national highway has to be expanded to become 6-lane national highway, or some money has to be spent for maintenance of this national highway. So it means you are meeting operational requirement of existing project. In that case, it will be AIF2. For example, it could be infrastructure debt fund. And as far as AIF3 is concerned, they are very high risk funds, which are also called as hedge funds. Did not worry about AIF3 because it is little technical. Now let's understand what do you mean by fund of funds. So in case of fund of funds, what actually happens is, I told you about alternate investment fund. Alternate investment fund will mobilize money from different investors. Investor A, investor B, investor C. But one of those investor could be a fund of fund. This fund of fund is making investment in AIF. So this fund of fund will be called as father fund. Whereas this AIF1 into which father fund makes investment, we will call it as daughter fund. So it will mobilize money from different investors, one of which being the fund of funds. After it mobilizes the money, this money can be invested in startups, right? So we do have a fund of fund for startups, which is under SIDBI. So as you can see, this fund of fund for startups under SIDBI, it will give money to different alternate investment funds. And these alternate investment funds will in turn invest in startups. So think of it. When this startup is getting money, right? From where is the money coming? Money is coming from AIF. But from where is AIF getting money? AIF is getting money from the government as well as the private sector. So don't you think there's a mixture of financing to the startups from both government as well as the private sector? Because it's a mix of government and private sector financing to startups, that funding we also call it as blended finance. As you know, blend means mix of government and private sector funding. So we do have fund of funds for startups, electronics development fund, as well as fund of fund for micro, small and medium enterprises. So having understood the concept of fund of funds, let's move to the next concept of flipping and reverse flipping. So what do you mean by flipping? So let me just give you an example. Let's say there is a Indian startup company. This startup company is registered and headquartered in Bangalore. In case of flipping, what happens is this startup company registered and headquartered in Bangalore, this startup company becomes a subsidiary of a overseas holding company. So this startup company, if it becomes a subsidiary of overseas holding company, this process we call it as flipping. So this Indian company is now completely owned by overseas holding company. To make this simpler, let's understand this in much greater detail through a flowchart. So think there's a Indian startup registered and headquartered in India. This startup owns all the intellectual property rights as well as data. In this startup, you have 90% ownership of a Indian founder, 10% ownership of Indian investors, 10% ownership of foreign investors. This is prior to flipping. So this Indian startup is a wholly owned company registered and headquartered in India prior to flipping, right? Let's see what happens during flipping now. In case of flipping, what will happen is here is this Indian startup, right, based in, let's say, Bangalore. This Indian startup will transfer its shares to a overseas company. So what could happen is these investors, right, that Indian founders, Indian investors, foreign investors, they can establish a holding company, a parent company, let's say in Singapore or US, where there is more ease of doing business or where they might get certain tax benefit. There they'll establish a particular company. Once a company is established, to that particular company, they will transfer the shares of this Indian company. Think of it. If the shares of this Indian company gets transferred to this overseas company, this Indian company will now become a subsidiary of this overseas parent company. So as you can see, they'll transfer shares to overseas holding company registered in Singapore or USA, and holding company will now issue shares to the investors. Who are those investors? The investors are Indian founder, Indian investors, and foreign investors. So, think here, the founders and investors have now retained the same ownership through share swapping. What do you mean by share swapping? Share swapping, as the name suggests, you give up the shares of one particular company. In return, instead of getting money, you get shares of some other company. So that is what is share swapping. So what has happened here? The Indian founder, Indian investors, foreign investors, they have given up their shares in the Indian company, right? When they gave up the shares of a company registered and headquartered in India, in return, instead of getting money, they are getting the shares of the foreign overseas company. This foreign overseas company would now own 100% shares of the Indian company, right? So, Indian company now becomes a subsidiary of the foreign overseas company. You can see post flipping, Indian founder, Indian investors, foreign investors will have same ownership which they used to have before. But before this ownership, they used to have an Indian startup company. Now the same ownership they'll have in overseas holding company. And this overseas holding company will now not only own the Indian startup company, but it will also own intellectual property rights and data of this Indian startup company. So as you can very well observe here, you had a Indian startup company headquartered and registered in India, but this Indian company has now become a subsidiary of foreign overseas company. The Indian founder and investors who were shareholders directly of Indian startup company, now they have become the shareholders of foreign overseas company. This is what is called as flipping. But why is flipping taking place? Why does it take place? Obviously, there are multiple reasons. Reason number one, probably ease of doing business. India has made drastic improvements in terms of ease of doing business. But our ease of doing business is still considered to be poor as compared to countries such as Singapore or USA. Reason number two, if a company is headquartered in Singapore, and Singapore, as you know, is a tax haven, the companies enjoy tax benefits. Reason number three, the startup ecosystem in India is very vibrant. But one of the biggest problem of Indian startup ecosystem is that we do not have a large number of private equity or venture capital which provides funding to the startups. So some startups might set up their base in Singapore and US because it becomes easier for them to get the funding from these countries. Reason number four. See, for startups, what matters most is valuation. Valuation means how much is the worth of a particular startup. Some startups might feel that if they are registered and headquartered in other countries such as Singapore and US, they might get a better valuation. And if they get a better valuation, they can probably issue shares in Singapore and US, and they can mobilize huge amount of capital. And lastly, it is being said that IPR protection related to patents is not very strong in India, but it might be very strong in countries such as USA. So these are some of the reasons why some of the startups had flipped to other countries. But according to Department for Promotion of Industry and Internal Trade, in last few months, a lot of Indian startups have done a reverse flipping. Reverse flipping means Indian startups which were headquartered overseas, now they are shifting back their bases to India. Some of these Indian startups which have undergone reverse flipping include startups such as Grow PhonePe. So these are the startups. And now even Zepto is also said to undergo reverse flipping. So what has happened that these startups are now coming back to India? Reason number one. Recently, the government of India has abolished the angel tax, which was earlier imposed on startups. So now they are getting tax benefits in India. Reason number two, because of Startup India, the startups are getting large number of benefits. As I discussed, ease of doing business has improved. Funding to startups through fund of funds has increased, plus incubation for startups has increased, right? Apart from that, now the capital market in India has also become very vibrant. So you must have heard of a lot of startups having issued shares in India. Example being Paytm, Zomato, Nika, all of this have issued shares, which means now the Indian startups believe that they could get a better valuation if they're headquartered in India. So these are some of the reasons why that reverse flipping is taking place. So let's take up the practice question number 4. Which among the following correctly depicts the definition of startup company in India? So the right answer is B. An entity which is less than 10 years with an annual turnover not exceeding rupees 100 crores for any of the financial years. That is the right answer. Which among the following best describe the concept of flipping of Indian startups which was recently in news? Answer is C. Converting Indian startup company into subsidiary of holding company located overseas. Let us now move to the next topic. The next topic is with respect to stress in the microfinance sector. Recently, the Reserve Bank of India has published the Financial Stability Report, in which RBI has raised concerns with respect to the rising stressed assets in the microfinance sector. Why is this topic important? Reason number one, as you can see in prelims 2011, a question on microfinance has been asked. Reason number two, in prelims 2023, a question on SHGs has been asked, and generally SHGs receives loans through the microfinance. So keeping in mind the requirement of UPSC prelims, we'll understand the meaning, significance and RBI's guidelines on microfinance sector, and also the difference between self-help group and joint liability group. At the end of which we will take up these two practice questions. So let's understand, what do you mean by microfinance loans? See, generally, when you look at the banks, the commercial banks, they generally give large value loans, and they generally give loans after accepting something as a collateral. Third, the banks do not provide for any kind of flexibility in repayment of loans. But if you look at these three features of large value loans, loans supported by collateral, lack of flexibility in terms of repayment, these features go against the interest of poor people. Reason being, poor people require small value loans of, let's say, 50,000 or 1 lakh. Poor people do not have anything to keep as a collateral. And third, poor people need flexibility in terms of repayment of loans. Think of a particular farmer. A farmer cannot give a commitment that on a particular date of a month he will compulsorily pay the EMI, because the farmer is not a salaried employee. But the farmer can give a commitment to make the repayment of loans after the harvest season, right? So poor people should be given the flexibility in terms of making repayment of loans on a day-to-day basis, or on a weekly basis, or on a seasonal basis, right? So to address the problems of poor people and to improve the financial inclusion in India, we have microfinance loans. So microfinance loans are small value, collateral free loans given to poor households with a flexibility of making repayment as per their own convenience. So this is what is microfinance loans. Who provides for microfinance loans? Microfinance loans are provided by different categories of banks as well as NBFCs. And these NBFCs which give microfinance loans, we call them as NBFC microfinance institutions. So you can see here the microfinance loans, as you can see, they are given by scheduled commercial banks, regional rural banks, cooperative banks, small finance banks, and NBFC microfinance institutions. Some of the microfinance loans can also be given by trust as well as societies, which are generally non-profit. They are not focused on making profit. They are mostly to promote self-help among the people. So because of these characteristics of microfinance loans, we have a lot of benefits like financial inclusion, poverty eradication, women empowerment, ease of credit, higher income levels of the people, and more importantly, it will build social capital. Social capital means when people come together because of convergence of interest. So what they cannot achieve individually, they can achieve that by being a part of group. Think of example of SHGs, right? So SHG is the best example of social capital. Some unique features about microfinance is number one, 90%, 99% of microfinance loans are provided to women. 98% of microfinance loans are provided through joint liability groups. So you must be thinking, what are joint liability groups? How are they different from SHGs? That is our next part. Loans, generally, they are given for income generating activities. But at the same time, some of the microfinance loans can also be given to meet household consumption expenditure like education, health, or marriage expenses. All these institutions which are involved in giving microfinance loans, they are regulated by RBI, except the non-profit microfinance institutions, which is trust and societies. They are not regulated by RBI. Now coming to RBI's guidelines on microfinance sector, which was issued in the year 2022. One, earlier, RBI's guidelines on microfinance loans was applicable only to the NBFC MFIs. So even though scheduled commercial banks, RRBs, cooperative banks, small finance banks, they used to give microfinance loans, RBI's guidelines was not applicable to them. So RBI has addressed this flaw now, and RBI said whatever guidelines it lays down, these guidelines will be applicable to all the regulated entities. So RBI's guidelines are not applicable only to trust and societies, except them it is applicable to all other regulated entities. Earlier, there was no common definition of what constitutes a microfinance loan. Now we have a common definition. The common definition is microfinance loan is a collateral free loan given to households having household income below rupees 3 lakh. And as you can see in the bracket I mentioned, irrespective of end use. It means microfinance loans can be given for income generating activities, and at the same time, some of the microfinance loans can also be given for meeting household consumption expenditure. With respect to how much loans should be given to one single borrower, RBI has set a limit that only that much amount of microfinance loans should be given to single borrower, such that repayment obligation on such loans is not more than 50% of the monthly income of the borrower. What does it mean? Let's say the monthly income of the borrower is rupees 10,000. 50% of 10,000 means rupees 5,000. So this borrower should be given only that much amount of microfinance loan, such that in one particular month he should not be making a repayment of loans of more than rupees 5,000. Earlier, RBI used to regulate the interest rate charged by microfinance institutions. But now RBI has deregulated the interest rate on loans, which means all these entities now can give microfinance loans at an interest rate which is market determined, and RBI will not interfere in fixing the interest rate unless the interest rates which RBI thinks is too high. So this is the latest development. RBI has now given a definition of NBFC MFI. According to RBI's definition, NBFC MFI is a NBFC which has minimum 75% of the assets in microfinance loans. Remaining 25% of the loans NBFC MFI can give as normal loans, but at least 75% of the assets should be microfinance loans. Next is we have an entity called as Microfinance Institution Network. Why is it important? It is important because it is India's first self-regulatory organization. And as a self-regulatory organization, RBI has appointed this organization in order to monitor the NBFC MFIs. So what is the role of self-regulatory organization? As the name suggests, self-regulatory organization, number one, it will monitor whether the NBFC MFIs are following the rules and regulations prescribed by RBI. Number two, it will submit regular reports to RBI with respect to the functioning of NBFC MFIs. Number three, the self-regulatory organization can also lay down code of conduct for NBFC MFIs. Fourth, it can also lay down its own rules and regulations to be followed by NBFC MFIs. This MFIN, it has membership from banks, NBFC MFIs, credit bureau, as well as fintech. Lastly, like I said, RBI's financial stability report has highlighted that the stress assets in the microfinance sector have been increasing. What are the reasons? Reason number one, over leverage borrowers. Over leverage borrowers means the best part about microfinance loan is it is small value, it is collateral free, and it is given with a flexibility of repayment. This best part can also become the worst part, because people can end up over borrowing money, and if they end up over borrowing money, they might not be able to repay the borrowings, and hence they will default on repayment, right? So that is problem number one. Second, because RBI has deregulated the interest rates on the loans, some of the NBFC MFIs have been giving loans at a very high interest rate. Now, poor people, because they're getting loans easily, they might end up taking loans even if the rate of interest is higher. And later, the high interest rate could actually act as a deterrent for these people from repayment of loans. Poor credit risk appraisal by the NBFC MFIs. And last is increase in frauds. These are some of the reasons. And like I said, you should also know what is the difference between SHG and joint liability group. Let's understand the difference. During your childhood days, I'm pretty sure all of you must have heard about this particular proverb: unity is strength, right? United we stand, divided we fall. The same philosophy is there with respect to both self-help group as well as joint liability group, which means if we are not able to achieve something individually, we can achieve the same thing by being a part of a group. The same philosophy is there in SHG and joint liability group, but there's a minute difference. What's the difference? As we can see, self-help group has 10 to 20 members, whereas joint liability group has 4 to 10 members. So that way, joint liability group is a smaller group as compared to SHG. The criteria for membership is same for SHG and joint liability group. Like, they follow one family, one member rule, and usually the members of SHG or members of a joint liability group, they belong to same social and financial background. But SHGs mainly target women. Joint liability group target people who belong to similar profession. For example, landless farmers, tenant farmers, sharecroppers, or people who are into tailoring business, right? Focus of SHG is twofold. One, to promote financial savings, and second, to provide credit. But the focus of joint liability group is to provide credit. Why are we saying so? You'll understand now. In case of SHG, the criteria to avail loans is that first SHGs should save money. Once they save money, only then the SHGs can take loans. So SHG focus on a philosophy which is save first and credit later. But as far as joint liability group is concerned, there's no need to have the savings first to take loans. That is why the focus of joint liability group is mostly on providing credit. In case of SHG, there's a limit on how much loans will be given to them. And that limit on loans is linked to how much money the self-help groups are saving. Usually, the loan sanctioned to SHGs is 4 times the savings. So if SHGs save 10,000 rupees, they'll get credit of 40,000, 4 times. So total corpus will be 50,000. But there's no such thing as far as joint liability group is concerned. Nextly, one of the most important difference between these two is in case of SHGs, bank will never ever give loans to individual members. Banks will always give loans to SHG as a group. But in case of joint liability group, the loans can be given to individual members also, and the loans can be given to the group as a whole. That is one major difference. Second is with respect to liability. Now, what actually happens in case of SHG is there's a group liability. What is a group liability? You have a bank will not give loans to a single member of SHG. Bank will give loans to the entire SHG as a group. What will SHG do is once it gets a credit loan from a bank, SHG will then distribute that loan among its members. But here the group as a whole becomes liable to pay back the loans which it has availed, right? So that is what is called as group liability. What about joint liability? That is for joint liability group. In case of joint liability group, like I said, if there are 4 members in a joint liability group, one member can take a loan directly from a bank. But when this one member takes the loan from a particular bank, other 3 members of joint liability group also become liable for repayment of the loan taken by this one member. Just like I and you are part of joint liability group. If I individually take loan from a bank, you are also liable to repay the loan if I don't repay. So that is the concept of joint liability group. Next is, are the loans given to SHGs and joint liability groups considered as priority sector loans? Yes, both are considered as priority sector loans by the Reserve Bank of India. Some of the well-known examples of SHGs include Kerala's Kudumshri, Self-Employed Women's Association in Gujarat, Karnataka's Mairada, and some of the famous examples of joint liability groups include Assam's Asha joint liability group, where this particular joint liability group is into tailoring business. And then there is Kerala's Priyadarshini joint liability group, which is into dairy farming. These are some of the successful examples. So having understood this, let's take up the practice question number 6. Consider the following statements related to microfinance loans in India. Microfinance loans are collateral-free loans given to households below having income level below threshold level, correct? Loans backed by hypothecation of any security can be treated as microfinance loan. In this particular case, hypothecation basically means collateral. So are the microfinance loans given against any collateral? Absolutely not. That is why the statement is incorrect. All the microfinance loans, including non-profit institutions, are regulated by RBI. Incorrect. Answer is one only. Consider the following statements related to joint liability group in India. Unlike self-help groups, the individual members of joint liability group can take loans from the banks. Correct. The joint liability group need to save money. Incorrect. Each group member of joint liability group assumes the credit risk of other members. Correct. So answer is 1 and 3 only. Let's now move to the next topic. The next topic is the topic of data embassies. In the Union Budget 23-24, the Finance Minister declared that India would set up data embassies. Accordingly, it was reported in Business Line that India has a huge potential to become a hub for data centers. And one of the recent development is that India is right now in talks with UAE, and it is being said that UAE might very well become the first ever country to set up data embassy in India. So as far as your prelims exam is concerned, you should know what is the meaning of data embassies, what is the mechanism and the significance. Based upon that, we'll take up these two practice questions. So let me explain what exactly is data embassy. See, all of you are preparing extremely hard for the upcoming prelims examination. All of you, I'm very sure you must be making short notes for each and every subject. Some of you must be in habit of making short notes on your tablets or on your laptop. See, it might so happen that whatever hard work that you have put to make your short notes on the laptop or tablet, that particular hard work might be lost if your laptop or your tablet, let's say, crashes. Then you lose access to all the hard work that you have put in, right? So it's like this. You prepare your short notes, concise note for prelims on the laptop, but you realize that your laptop has crashed. So how do you protect yourself in such cases? In such cases, you should take a backup of your notes so that even if your laptop crashes, you'll still have access to backup of these notes from the cloud, right? The same concept is introduced as far as the data embassies is concerned. Now, what we are saying, that is, we as a country, what we are saying to other countries is, we are saying to other countries that look, if you have certain critical, confidential, and sensitive data about your citizens, that data in your country might come under threat because of some cyber attack, because of some natural disasters. So we are asking those countries to keep a backup of their data in India. So those countries will set up data centers in India, and in these particular data centers, they will be holding a copy of their confidential and sensitive information. The concept of data embassy is almost similar to diplomatic embassy. For example, in India, you have other countries who have set up their diplomatic missions, right? Same way, other countries will set up their data centers in India. If you look at diplomatic missions of other countries in India, right? Even though they are physically located in India, they are not governed by Indian laws. They are governed by the laws of the respective country, right? Same way, if other countries are setting up data centers in India, these data centers will not be under the purview of domestic rules and regulations, that is India's rules and regulations. Those data centers will be governed by the rules and regulations of the country which is setting up data embassy in India. Just like if UAE sets up a data embassy in India, the data which is in India will be owned and managed by UAE. The data in India will be governed by UAE's laws and regulations. As of now, data embassies are not given special protection against under the Vienna Convention. So you know that under the Vienna Convention, diplomatic missions, they enjoy immunity from domestic rules regulations. But data embassies are not given protection under the Vienna Convention. So to give that kind of protection, we need to have a bilateral agreement with the concerned country. Like if you have an agreement between India and UAE, and if UAE sets up a data embassy in India, that data embassy in India will not be protected under the Vienna Convention. It will be protected under the bilateral agreement between India and UAE. So if you look at the details, you can see data centers set up by country outside the physical border, and just like foreign embassies, data embassies are governed by foreign laws. The world's first data embassy has been established by Estonia in Luxembourg. In fact, Monaco has also established its data embassy in Luxembourg. The rationale is to ensure that the countries are able to save their critical data across the world and ensure that they have access to that particular data in case of cyber attacks and disasters. And as far as our proposal is concerned, we have proposed to set up data embassies in the financial SEZ of India, that is Gift City, located in Gujarat. What are the benefits? As you know, India is already considered as a software capital of the world. In future, if other countries are setting up their data embassies in India, there will be huge investment in data centers. And you know, data is a new oil, right? So India might get immensely benefited if countries are shifting their data to India. And if they store the data in India, India could very well become the next hard drive of the world. So India is just now software capital. From software capital, India can also become the world's hard drive. So that is why we are trying to promote data embassies. So based upon that, let's look at the practice MCQ number 8. Which among the following best describes the concept of data embassies proposed in the Union Budget 23-24? As you can see, the right answer to this particular question is C. Data centers set up by foreign governments in India to store sensitive and confidential information. Consider the following statements. Data embassies enjoy diplomatic immunity and hence are not subjected to domestic laws of the host country. Do they enjoy diplomatic immunity? Yes. Are they subjected to domestic laws of the country? Obviously not, right? So the first statement is correct. Data embassies are given protection under the Vienna Convention. Like I said, they are not given protection under the Vienna Convention. Rather, they are given protection again under the bilateral agreement which India would sign with other countries. So the right answer in this particular case is C. Statement 1 is correct and statement 2 is incorrect. Let's move to the next topic. The next topic is related to reforms in the agricultural marketing. As you all know that now the farmers protest 2.0 is going on. The farmers have a number of demands, and one of the biggest demand of the farmers is to provide for legalization of MSP. But it is being said that legalization of MSP is not the right way to protect the interest of the farmers. A lot of economists have argued that instead of providing for legalization of MSP, we need to protect the interests of the farmers by controlling the volatility in agricultural commodities. So, if you see the previous year mains questions, repeatedly questions have been asked with respect to the challenges in agricultural marketing. So, going forward, we might get a question about what strategies should the government adopt in order to ensure remunerative prices for the farmers. Based upon this, you can get this particular mains question. The question is, the government intervention to control price volatility often works against the interests of the farmers. Explain the statement. Also discuss the policy measures to reduce price volatility of agricultural commodities. You have this particular prelims question. So let's understand about the problems faced by the farmers in India. According to this year's economic survey has highlighted that if the prices of agricultural commodities reduce, farmers obviously incur a loss. But if prices of agricultural commodities increase, even in that particular case, also the farmers incur a loss. Now, this is actually irony because actually, if prices increase, farmers should get benefited, right? But why do farmers not get benefit if there is increase in prices of agricultural commodities? This is so because the government intervenes in the market to reduce the prices of agricultural commodities and protect the interest of the consumers. The government, by reducing the prices of agricultural commodities, protects the interests of consumers, but it ends up adversely affecting the interest of the farmers. This is what the economic survey has highlighted. For example, let's say there is increase in the prices of agricultural commodities. In that particular case, government will intervene in the market. In what way? The government might put a ban on export of commodities. The government might import more commodities, or government might put a ban on futures trading. By undertaking all of these steps, government reduces the prices of agricultural commodities. But in doing so, government ends up adversely affecting the interest of the farmers. So, according to well-known member of Niti Aayog, Mr. Ramesh Chand, he has highlighted that the terms of trade for the farmers, as you can see highlighted by this blue color line, the terms of trade has remained almost stagnant in the last 10 to 15 years. So what is the meaning of terms of trade? So if you see terms of trade, it is prices received by farmers, obviously when they sell their agriculture produce, divided by prices paid by farmers on all inputs, including consumer goods. So if you look at denominator, farmer has to purchase different inputs like seeds, fertilizers, agricultural machineries, pesticides, and farmer might also purchase consumer goods like clothes, shoes, TV, and so on. So how much price the farmer is receiving when he sells the agriculture produce divided by the price which the farmer is paying on all inputs, including consumer goods. So think in this particular case, if the numerator value is higher and denominator value is lower, in that particular case, the terms of trade would obviously would be more than 100%. On the other hand, if numerator value is less and denominator value is more, then the terms of trade would be less than 100%. And this is what the Niti Aayog member, Mr. Ramesh Chand, has pointed out. The terms of trade is below 100%, which means the prices which the farmers are receiving when they sell the agriculture produce, that is lower as compared to the prices which the farmers are paying on all their inputs, including consumer goods. So farmers are at a disadvantage. So what steps should the government take to control the volatility in agricultural commodities? Let's understand the steps one by one. Number one, why is there so much price volatility in agriculture commodities? The reason being, even today, 52% of area under irrigation of agriculture land is under irrigation, which means 48% of net sown area is still under rain-fed agriculture, which means if there's a failure of monsoons, then there will be decrease in production, and decrease in production could lead to increase in prices, right? So to control price volatility, we need to increase the area under irrigation and also undertake crop diversification. Right now, the farmers are being exploited when they go to sell their agriculture produce in mandis by the traders. So we need to give the freedom to the farmers to sell the agriculture produce outside the mandis. Let's say directly to an exporter, directly to a processor. By doing so, you are giving more bargaining power in the hands of the farmers. We must organize the farmers into farmer producer organizations because they would have more marketable surplus, and if they have more marketable surplus, their bargaining power when they go to sell the agriculture produce increases. Number one. Number two, more marketable surplus means they can undertake value addition and realize higher prices. For example, if they are having fruits and vegetables, they can process the fruits and vegetables into processed foods and get more prices. We must encourage contract farming. We must amend the Essential Commodities Act. The reason being, under Essential Commodities Act, the government keep on imposing restrictions on stock holding. That is how much food grains, how much fruits and vegetables can be stored by the traders, food processing industries, and so on. Because of that stock holding restrictions repeatedly imposed, the storage infrastructure in India has not developed adequately. In fact, it being said that our storage capacity is just around 47 percentage of the total production. So because of poor storage infrastructure, we have higher post harvest losses. So according to some estimates, 25 to 40% of agriculture produce get wasted every year. So when they get wasted, obviously the prices of agriculture commodities would increase. So to counter this, we have to amend the Essential Commodities Act, do away with the stock holding restrictions, and encourage more investment in storage, that is construction of godowns and cold chain infrastructure. Government interference in controlling prices should be very limited. In fact, economic survey has pointed out that whenever government intervenes in the market to control the prices, it ends up adversely affecting the interests of the farmers. So government interference such as ban on exports, ban on futures trading should not become a regular feature. In fact, they should be resorted to only in certain exceptional circumstances. Next, this year's economic survey has highlighted that instead of targeting headline inflation, we should start targeting the core inflation. You know that headline inflation is your CPI inflation, which measures inflation in 299 commodities, including food. That is headline inflation. But if you see the inflation in food, it is not caused due to demand side, or it is not caused due to increase in demand. Mostly the food inflation is caused because of supply side, like decrease in production or post harvest losses and so on, over which RBI has very limited control, right? RBI cannot take drastic measures to increase the supply of commodities. That is the responsibility of the government, right? So this year's economic survey has highlighted that it is very wrong for the RBI to target the headline inflation. Instead of headline inflation, RBI can think of targeting the core inflation. Core inflation, as you know, means same as CPI inflation, but it will exclude volatile commodities, that is food and fuel. And lastly, we must have a dynamic buffer stock policy. For example, it is being said that when it comes to buffer stock, we generally maintain buffer stock of only certain commodities like rice and wheat. We don't maintain adequate buffer stock of other commodities in which we face inflation repeatedly. Take, for example, pulses or fruits and vegetables like onion, potato, tomato, and so on. So what we have to do is our buffer stock should not be just limited to rice and wheat. Our buffer stock should be expanded to include other commodities as well. By doing so, the need for government to intervene in the market to reduce the volatility will drastically reduce. So these are some of the steps that can be taken to control the price volatility. Based upon this, you can have a look at the question here. The government intervention to control price volatility often works against the interests of the farmers. Explain the statement. Discuss the policy measures. So in the body of the answer, there will be two parts. First part, you need to explain how government intervention to control price volatility affects the interests of the farmers. Part two, what strategies we must adopt, right? So as far as introduction is concerned, in the introduction, you can elaborate the statement given in the question. For example, you can write, the government intervenes to control price volatility through stock holding restrictions under Essential Commodities Act, ban on exports, future trading to protect the interests of consumers. However, such form of government intervention, though well intended goes against the farmer's interest. In the body of the answer, two parts. And if you have written the strategies in the body of the answer, the conclusion could be what would be the long term implications of such strategies, right? So here the conclusion could be the adoption of above strategies would enable us to reduce price volatility, prevent distressed sale, encourage investment by farmers, leading to evergreen revolution in agriculture. Now coming to the important term in news. As you can see, recently it was reported in Business Standard that interest coverage ratio of unlisted companies is at 30-year high. This is important because a question on interest coverage ratio has already been asked in prelims 2020. So what we will do, we will understand two related terms. One is interest coverage ratio and the other one is debt coverage ratio. Let's say there is a particular company. This company has borrowed 1000 rupees and this is a total accumulated borrowing. And in this particular year, it is required to repay back 100 rupees. That is the principal which is due is 100 and interest which is due is rupees 10 on the total borrowings of rupees 1000. So to measure whether the company will be able to repay its interest and principal and interest, the two things, we have two concepts. One is interest coverage ratio and debt coverage ratio. Interest coverage ratio, as the name suggests, measures the ability of the company to repay the interest due in a particular year. Interest coverage ratio is calculated as profits divided by interest due. That is how much profit the company is earning in a particular year. So think of it. If in a year profit earned by the company is more than the interest due, how much is the interest due? Rupees 10. And let's say the company earns a profit of rupees 15. It is earning a profit of rupees 15. Interest due is 10. So the interest coverage ratio will be more than 1. And if it is more than 1, the company will be able to repay the interest. So looking at the formula here, because interest coverage ratio is profits divided by interest due, we can say higher the interest coverage ratio, which means higher the profit and lower the interest due, higher the interest coverage ratio, higher the capacity of the company to repay the interest. On the other hand, if profits earned by a company in a particular year is less than the interest which is due, interest due is 10, profit earned by the company is rupees 5. 5 divided by 10, interest coverage ratio will be less than 1. If the interest coverage ratio is less than 1, then the company is called as zombie company. Why it is called a zombie company? Some of you must have seen the zombie movies, right? So zombies are the people who are infected, right? And these zombies, if they bite the normal people also become zombies, right? Because they are passing on the infection, right? Same way, we call these companies as zombie companies because these companies have already failed. They are not having the capacity to repay the interest. They have already failed. But if they don't repay the interest to the banks, what happens to financial position of the banks? Financial position of the banks will also worsen. So the zombie companies are on the verge of collapse, but they're also taking the bank along with them, right? That is why we call them as zombies. Debt coverage ratio, on the other hand, measures the ability of the company to repay back both its principal due and interest for a particular year. It is calculated as profits divided by principal and interest due. So how much is the principal and interest due? 100 plus 10. Total is 110, right? So if profit earned by the company is more than the principal and interest due, let's say profit earned by the company is 220 and principal and interest due is 110, interest coverage ratio will be equal to 2, which is more than 1. So, higher the debt coverage ratio, higher the capacity to repay principal and interest due. On the other hand, if debt coverage ratio is less than 1, which means profit is less than the principal and interest due, then that particular company will be unable to repay its principal and interest due in a particular. That is the concept of interest coverage ratio. So based upon our understanding, I'm pretty sure you can easily solve this question. Practice MCQ number 11. So the right answer in this case is D. Ability of a company to repay both its principal and interest due in a year from its profits. Now coming to the last section of this particular session, that is important schemes in news. In this year prelims examination, we had almost 3 to 4 questions related to schemes. For example, we had this particular question related to Pradhan Mantri Surakshit Matritva Abhiyan. Now, why was this question asked in prelims 2024? Because as you can see in Feb 2024, Health Ministry expanded this particular scheme for the pregnant women. Basically, in this particular scheme, we brought about modification to monitor high risk pregnancies, and that change was made in Feb 2024, which was before the prelims of 2024, which clearly shows that this particular scheme was in news before the prelims. The second question was with respect to Pradhan Mantri Shram Yogi Mandan. Even this scheme was in news in April 2024, wherein it was highlighted that in spite of 5 years since this particular scheme has been launched, the number of enrollment of unorganized workers in this particular scheme is quite lower. So even this scheme was in news. Look at this corporate social responsibility. Now, why was it asked? The reason why it was asked is because in April 2024, we celebrated 10 years of introduction of corporate social responsibility. So what I'm trying to say is, if UPSC asks questions related to schemes and policies, generally it might mean that those schemes and policies might be in news for certain specific reason. So if you want to prepare for schemes and programs, do not prepare for schemes and programs as a standalone subject. Rather, prepare for schemes and policies as part of your current affairs. So whenever you come across some important schemes in news, incorporate that into your notes and you can revise them just before the prelims examination. So what I will be doing henceforth from this particular week is, if at all any scheme is in news, I will incorporate those schemes in news in my PPT along with the practice questions. You can just go through the schemes details and also solve the practice question and let me know the answers in the comment box as well. For example, you can see Pradhan Mantri Jan Arogya Yojana was recently in news because Odisha has become the 34th state in the country to implement the Pradhan Mantri Jan Arogya Yojana. All the details are given here along with the practice question. Next is about PM Kisan. Recently, all of you must have come across this particular article in the Hindu newspaper related to PM Kisan. So accordingly, I have highlighted the important details about PM Kisan along with a practice question. Please go through these schemes and policies, try to solve the practice questions and comment your answer in the comment box. Thank you so much. This is the end of our discussion. I'll meet you next week. Thank you so much. Keep studying.